Welcome to this explainer. Today, we're diving headfirst into a truly fascinating financial paradox unfolding right in front of us this August of 2026. We're talking about HDFC Bank, India's absolute largest private sector lender. On paper, it is a colossal, dominant franchise. But lately, it's become a massive battleground of contradictions. We're seeing record-breaking global fundraises and huge regulatory approvals happening at the exact same time the stock is facing some of its most severe downward pressure in recent memory. By the end of our time together, you're going to understand exactly what is pulling this banking giant in two completely different directions.
Here is our roadmap for today. We'll start with the HDFC Bank paradox, move into the Q1 results and the stock slump, break down that record dollar fundraise, examine the leadership, governance, and the bulls, and finally, weigh the key risks for our final verdict.
All right, part one, the HDFC Bank paradox. The disconnect going on right now is just profound. When you look at the numbers, HDFC Bank is down roughly 26% year to date. Meanwhile, the broader Nifty 50 index, it's only fallen about 7%. That is a massive, glaring underperformance. The stock recently hit a 52-week low of 715 rupees, meaning it's lost roughly 37% of its value from its peak just last October. For a fundamentally dominant $118 billion giant, a drop this steep really demands our attention. And technically speaking, the weakness is severe. It's been stuck trading below both its 20- and 50-day exponential moving averages, which is a classic sign of persistent selling pressure. The Relative Strength Index, or RSI, is sitting at a weak 41.40, well below that neutral 50 mark. Analysts are keeping a very close eye on that crucial support level between 720 and 705 rupees. If it closes decisively below 710, things could get ugly. So essentially, the stock is trapped in a multi-month consolidation phase, just really struggling to find its footing.
Moving on to part two, Q1 results and the stock slump.
So, diving into their July Q1 FY27 results, we find some pretty interesting clues. Now, they did see a 5% year-on-year profit increase, pulling in over 19,000 crore rupees. But they still missed market expectations. The street was looking for something slightly over 19,300 crore. They also missed the estimates for net interest income. So while the top-line growth and healthy loan advances are absolutely there, these missed estimates have just deeply weighed on investor sentiment. But there's one specific metric that's spooking the markets more than anything else.
And it's this number right here, 3.26%. This is HDFC Bank's net interest margin, or NIM, for the quarter. And guys, this is the lowest level on record for the bank. Think of NIM as the core engine of a bank. It measures the difference between what they earn on loans and what they pay out on deposits. A shrinking NIM means the fundamental profitability of their lending operations is getting squeezed tightly.
To figure out why that margin is getting crushed, we've got to talk about their loan-to-deposit ratio, which currently sits at a dangerously high 96%. Simply put, for every 100 rupees they hold in deposits, they're turning around and lending out 96 rupees. This is one of the absolute highest ratios in the entire industry. Because they are stretched so incredibly thin, they are practically forced to offer higher and higher interest rates to attract more customer deposits. And those higher deposit costs? That's exactly what is eating into that 3.26% profit margin we just talked about.
Which brings us to Section 3, the record dollar fundraise.
Now here is where the paradox really deepens. $1.75 billion. That figure represents the largest single-shot debt fundraise by an Indian bank since the 2008 global financial crisis. And they raised this directly out of their Gift City branch. It is a monumental show of institutional muscle, especially for a bank whose stock has been taking such a beating domestically.
Breaking this massive raise down, they used a dual tranche structure of 3-year and 5-year senior unsecured fixed-rate notes. But here's the crazy part. It generated a staggering $7 billion order book. Think about that for a second. Global institutional investors literally lined up to offer 4 times the amount the bank was actually asking for. It proves beyond a shadow of a doubt that there is massive, undeniable global confidence in HDFC Bank's long-term stability. I mean, they didn't just get the cash, they reaffirmed their solid investment-grade ratings from Moody's and S&P.
So why go after dollars right now? Well, it's highly strategic. First, they are capitalizing on the RBI's concessional 1.5% FX swap facility, which basically unlocks much cheaper funding. Second, they need to fund overseas operations and diversify where their money comes from. But most importantly, Injecting this offshore capital helps ease that massive 96% loan-to-deposit ratio we highlighted earlier. They are finding very creative, global ways to relieve their intense domestic pressure.
Okay, let's pivot to Section 4, Leadership, Governance, and the Bulls.
It is no secret that it's been a turbulent year in the boardroom. Back in March of 2026, the sudden resignation of their chairman over ethical differences really shook the market. But the course correction actually came quite swiftly, culminating in the RBI appointing former Finance Secretary Rajiv Kumar as chairman in July. He brings decades of high-level public policy and banking reform experience, which global brokerages like Jefferies are viewing as a massive, much-needed governance boost to finally stabilize the ship.
Then we have another massive potential stabilizing force entering the picture, the Life Insurance Corporation of India, or LIC. They just got regulatory approval to more than double their stake in the bank, going from around 4.1% up to 9.99%. This is huge. Foreign portfolio investors have been dumping HDFC heavily. In fact, HDFC alone accounted for a staggering 30% of all FPI outflows in the March quarter. Having India's largest institutional investor ready to step in and aggressively scoop up those shares could act as a vital, much-needed safety net for the stock.
And this institutional confidence brings us straight to the Wall Street perspective. Goldman Sachs recently initiated a buy rating on the stock with an 861 rupee target. They are boldly declaring that the private banking sector is at a major inflection point, driven by earnings acceleration and fundamental franchise strength. They see the current valuation, trading at roughly 14 times trailing earnings, as a highly attractive entry point for long-term investors.
Bernstein is echoing that exact same sentiment. They're calling India's banking sector a sweet spot right now, with loan growth hitting multi-year highs. They've actually set a massive 1,150 rupee price target, which, if you do the math, implies over 58% upside from current levels. So, while domestic retail investors might be sweating over the short-term charts, the global institutional heavyweights are looking at the exact same data and seeing a coiled spring just waiting to bounce.
Finally, Section 5, Key Risks and our final verdict.
To be perfectly objective, we have to look at the bear case, which really boils down to 5 brutal headwinds. You've got that record low NIM and the 96% loan-to-deposit ratio acting as a very real operational bottleneck. On top of that, persistent foreign portfolio outflows and the lingering anxieties over those recent governance controversies show that trust still needs to be rebuilt. And let's not forget, the massive historical merger with HDFC Limited is still a work in progress, and unlocking those promised synergies is clearly taking a lot of time.
To make matters a bit tougher, cheap, low-cost CASA deposits have slipped down to 32.3%, squeezing their overall profitability even further. And the kicker? Management themselves don't expect this pressure to ease up until late 2027. This isn't some quick overnight fix. This is a deep, structural challenge that is going to take over a year of absolute grinding execution to resolve.
So, as impartial observers, we're basically looking at a tale of two banks. On one side, the bull case, a fundamentally incredibly strong $118 billion giant boasting massive global bond demand, deeply bullish analyst price targets, and an expanding LIC safety net. On the other side, the bear case, a technically weak stock fighting severe margin compression, a suffocating loan-to-deposit ratio, and recent governance fears. The recovery here absolutely hinges on their ability to stabilize those margins and execute cleanly to restore investor trust.
Which leaves us with one massive, lingering question to consider today. Based on all the evidence we've just unpacked in this explainer, from the painful technical charts to the record-breaking global confidence, is this stock a value trap destined for prolonged stagnation, or is it genuinely the most compelling entry point of the decade for a legacy banking franchise? It is an absolutely fascinating paradox. Thank you so much for joining me to decode it. Keep learning, keep analyzing, and I'll catch you in the next explainer.